AI earnings are firing on all cylinders just as central banks talk tougher on inflation, and that clash is now defining the risk and reward in equities. You're watching vTalkInsight, Equity Pulse Daily for June 1st, 2026. Let's start with how a record-breaking run in U.S. and global stocks is colliding with a higher-for-longer rates narrative and a fast-shifting energy backdrop. Equities head into June with the S&P 500 at record territory, on track for a ninth straight week of gains and fresh weekly advances for both the S&P and the Nasdaq. That strength is anchored in earnings, with S&P 500 profits projected to grow around 20% this year and another 10 to 20% next year, allowing the index to rise without needing more valuation expansion. High-frequency U.S. activity data continue to surprise on the upside, and recent weeks have brought widespread earnings beats, particularly from technology and AI infrastructure names. At the same time, several commentators describe equities as priced for perfection, meaning current levels leave limited room for disappointment on either earnings or the macro side without triggering a volatility spike. On policy, the Federal Reserve narrative has shifted away from cuts and toward a higher-for-longer stance. Officials from the St. Louis Fed and others now emphasize upside inflation risks, suggesting the current policy rate may be only at, or even a bit below, neutral, and markets have moved to price out cuts and even assign meaningful odds to a hike by March next year. Across the Atlantic, the European Central Bank is dealing with a more acute stagflation mix. Inflation in France and Spain has reaccelerated to multi-year highs, with Spanish core CPI near 2.9% year-on-year, while French GDP contracted by 0.1% in the first quarter, pushing markets to price more than 200 basis points of ECB tightening by year-end. Energy is the wild card where the story has evolved the most compared with recent days. Reports of a 60-day truce extension and potential reopening of the Strait of Hormuz between the U.S. and Iran have pulled Brent crude into its steepest monthly decline since 2020, flattened the oil forward curve, and knocked West Texas Intermediate roughly 10% lower this week, briefly easing inflation pressure and helping bond yields and equities alike. Yet beneath that relief, the physical market still looks tight. Global inventories have been drawn down sharply, with roughly 1 billion barrels removed over about 100 days. U.S. gasoline and diesel stocks are at their lowest since 2003. Refineries are running near capacity while exports stay strong, and parts of Asia are already rationing, all of which leaves the system vulnerable to renewed price spikes if demand holds or the ceasefire stumbles. The macro picture, then, is one of resilient growth and powerful earnings momentum, but layered over inflation that is still above target, central banks leaning hawkish, and an energy system that has lost much of its buffer. That combination keeps the odds elevated for a future shock from rates or fuel prices, even as the immediate tone feels risk-on, and it sets the stage for how equity leadership and valuations behave from here. Beneath the headline indices, market structure looks more fragile than record levels would suggest. Recent sessions saw only about 200 S&P 500 constituents advance, while roughly 300 declined, and several observations highlight that gains are increasingly concentrated in a small group of large-cap names, many tied to AI and technology. Passive investing and broad ETFs are reinforcing that concentration because flows naturally gravitate toward the winners already dominating the benchmarks. That dynamic raises questions about systemic risk if sentiment turns on just a handful of mega caps, and it helps explain why some see an emerging asset bubble, particularly when investors are increasingly favoring growth stocks at almost any price. There are also tensions between how the options market is priced and the narrative around risk. Commentary notes equity volatility rising alongside prices as investors chase upside, yet index-level gauges remain relatively subdued, and put options covering a mid-single-digit S&P drawdown are described as very inexpensive, implying it does not cost much to insure against a reversal after this 9-week winning streak. Credit markets, for now, are endorsing the equity rally. Investment-grade spreads in the U.S. are near their tightest levels in more than 2 decades, the market has already absorbed around $160 billion in new issuance, with another $40 billion expected, and strong demand has kept all-in yields attractive versus sovereign bonds, though several voices doubt there is much room for further tightening from here. Put together, equities are being powered by strong profits and ample liquidity, but on top of narrow leadership, stretched valuations, and tight credit spreads that leave little margin for error. History suggests that even outside crises, mid to high single-digit drawdowns are common within months of record highs, so upcoming inflation prints, central bank meetings, and any wobble in AI-related earnings could quickly test how durable this risk-on positioning really is. The defining driver of equity markets right now is the AI infrastructure build-out, which has moved from narrative to hard numbers. AI-related capital expenditure is estimated to exceed $900 billion next year and could peak above $1 trillion by 2028, with hyperscaler capex seen rising 25 to 30% annually and normalized cloud and AI spending already marked above $500 billion a year. Dell sits at the center of this, having just delivered quarterly revenue and earnings far ahead of Wall Street expectations, with AI server demand driving an 88% jump in first quarter sales, a 92% surge in traditional servers, and a reported backlog of about $51 billion. The company now projects around $60 billion of AI server revenue next year, supporting a more than 30% one-day rally in its shares and re-rating the broader tech hardware complex, while NetApp has similarly beaten guidance, raised its fiscal 2027 outlook, and seen its stock jump more than 20% on accelerating enterprise AI data infrastructure demand. Nvidia is reinforcing that trend from another angle, pairing strong free cash flow with a new shareholder return program that signals confidence in sustained earnings power from GPUs and related platforms. At the same time, the AI hardware story now stretches far beyond GPUs into CPUs, storage, networking, and optical components, with persistent shortages and year-long lead times in memory, processors, and hard drives expected to benefit suppliers such as Intel, AMD, ARM, Micron, SK Hynix, and others. The spillover is global. European names like Infineon, Alcatel, Nokia, and Soitec are cited as indirect beneficiaries through their roles in AI data center supply chains, and European tech indices have rallied accordingly, even as not every AI-linked company is delivering. With Sivers Semiconductors dropping nearly 5% after disappointing earnings and SentinelOne sliding around 20% on weak guidance and restructuring news, underscoring that this is an alpha-rich but selective environment. Outside pure tech, AI themes are reshaping legacy sectors and smaller caps. Ford has logged its best monthly performance in 17 years, helped by a high-profile note suggesting its energy storage and charging infrastructure could become a $10 billion business leveraged to AI data center power needs, while HP has rallied on improving corporate PC demand to support AI workloads despite margin pressure from rising memory costs. And AI infrastructure names have been major contributors to Russell 2000 gains, highlighting how small-cap, semi-cap equipment and defense-related plays are increasingly tied into this capex cycle. In private markets, Anthropic has become a symbol of the capital intensity and growth potential in this space. The company's valuation has reportedly surged toward $1 trillion, with run-rate revenue jumping from about $9 billion to nearly $50 billion in a short span, while major private equity firms arrange roughly $36 billion of debt financing for its AI infrastructure build-out, and investors focus on trends like hybrid compute, where firms such as Nvidia, Intel, and Apple are expected to benefit as workloads move fluidly between data centers and local devices. Despite the strength of this earnings engine, there are also notes of caution. Some argue that AI capex is increasingly driving revenues around in a closed loop within the sector, raising questions about the durability of growth once spending normalizes, and concerns about AI alignment, unintended model behavior, and calls from leading firms for slower development highlight that technology and regulatory shocks are non-trivial risks for a market now heavily dependent on this single theme. The shifting energy story and improving geopolitics could eventually drive a rotation in equity leadership. The The tentative U.S.-Iran ceasefire extension and talk of reopening the Strait of Hormuz have already cut crude prices sharply, and some see scope for a move out of perceived safe haven U.S. tech and into more cyclical or oil-sensitive sectors, with European equities in particular flagged as potential beneficiaries if energy risks continue to recede and help narrow their underperformance gap versus the U.S. At the same time, the consumer side of the economy is flashing more amber lights than the aggregate equity indices imply. U.S. credit card delinquencies rose over 13% in the first quarter. Total balances have reached about $1.4 trillion. Real incomes have declined in 5 of the last 7 months, and higher gasoline and energy costs have added an estimated $59 billion to household expenses, roughly $450 per average household, raising the risk that stretched consumers eventually pull back on discretionary spending. Company results mirror that tension. Gap shares fell more than 15% after weak Old Navy performance that management linked primarily to execution missteps, even as the group reported its 9th consecutive quarter of positive comparable sales and had previously guided to double-digit earnings growth, while American Eagle has struggled at the parent level even as its Aerie brand posted a 25% sales increase. And Costco has delivered stronger than expected earnings on the back of consumers trading down for value and benefiting from lower-priced gasoline at its pumps. Looking beyond mega-caps, there is a growing view that small and mid-cap equities may be significantly undervalued. Commentary highlights that the combined market capitalization of the S&P 1000 is still less than Apple's, implying ample room for stock pickers if earnings leadership continues to broaden, and some expect small and mid-caps, especially those tied to AI infrastructure, semi-cap equipment, and military modernization, to outperform over the coming decade as capital and fiscal spending filter through the wider economy. The primary market is also set to influence equity dynamics, especially around AI and space. Investor demand for upcoming mega-IPOs remains exceptionally strong, with SpaceX expected to list at around $1.8 trillion on a 3-class structure that would leave Elon Musk controlling roughly 85% of the votes. Index providers are accelerating inclusion of such giants into benchmarks. U.S. investors are taking up to 40% of some European IPO allocations, and Blue Origin's New Glenn rocket setback versus SpaceX's successful Starship launch underscores how technological differentiation and governance choices could matter for how these new listings trade once lockups expire and large amounts of new equity supply hit the market. Stepping back, the broader picture is of a market still driven by AI and tech leadership, but with more signs that earnings strength is spreading into areas like consumer cyclicals, autos, and select industrials, even as consumer balance sheets and higher rates inject downside risk. Whether leadership rotates toward these lagging segments and how well markets digest the forthcoming wave of AI and space-related IPOs may be crucial in determining if this rally matures into a more durable, diversified advance or stays vulnerable to a concentrated reversal. To wrap up, global equities are entering June with powerful tailwinds from AI-driven earnings, robust tech hardware and data infrastructure demand, and still supportive credit markets, all against a backdrop of resilient macro data. Set against that, valuations look full, leadership is narrow, central banks are signaling a higher for longer stance on rates, and the apparent relief in oil masks a structurally tight fuel market and mounting stress on consumer balance sheets. From here, the balance of risk and opportunity in equities hinges on 3 things: whether inflation and policy expectations stabilize, whether AI capex remains as strong as current projections, and whether earnings momentum can continue to broaden beyond a handful of mega-cap names into small and mid-caps, Europe, and more cyclical sectors. Investors will be watching upcoming inflation prints, central bank meetings, AI and tech hardware results, consumer data, and the first wave of mega-IPOs as key signals for how this delicate equilibrium resolves. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.